Good day again, everyone. To continue the discussion, I will now discuss the chapter 23, which is the mutual funds operations. The specific objectives of this chapter are first, to provide a background on mutual funds. Second is to describe the various types of stock and bond mutual funds. Third is to describe the performance of mutual funds. Then describe key characteristics of money market funds. And lastly is to describe other types of funds. For learning objective number 1, a mutual fund is an investment company that sells shares and uses the proceeds to manage a portfolio of securities. Mutual funds have grown substantially in recent years, and they serve as major suppliers of funds in financial markets. Also, it serves as a key financial intermediary. They sell shares to individual investors and invest the money they receive in a portfolio of securities for the investors. They accommodate financing needs of corporations by purchasing newly issued stocks and corporate bonds in the primary market. Mutual funds are sometimes referred to as open-end funds because they are open to investors, meaning that they will sell shares to investors at any time. In addition, they allow investors to sell or redeem the shares back to the fund at any time. For learning objective number 2, here are the various types of stock and bond mutual funds. First is the pricing shares of the mutual fund. The price per share of a mutual fund is equal to the net asset value or NAV per share, which represents the value of the portfolio per share after accounting for expenses incurred from managing the fund. Specifically, the net asset value is estimated at the end of each day by first determining the market value of all securities that constitute the mutual fund, or any cash is also accounted for. Second is mutual fund distributions to shareholders. Mutual funds can generate returns to their shareholders in three ways. First, they can pass on any earned income from dividends or coupon payments as dividend payments to the shareholders. Second is they distribute the capital gains resulting from the sale of securities within the fund. And a third type of return to shareholders is through mutual fund share price appreciation. As the market value of a fund's security holdings increases, the fund's NAV increases, and the shareholders benefit when they sell their mutual funds shares. The third one is regulation of mutual funds. Mutual funds must adhere to a variety of federal regulations. They must register with the Securities and Exchange Commission or SEC and provide interested investors with a prospectus that discloses details about the components of the fund and the risk involved. Information contained in a prospectus. Mutual funds are required to provide a prospectus with information about their objectives, management, and risk. Specifically, the prospectus is required to disclose the following information. Una, the minimum amount of investment required. Pangalawa is the investment objective of the mutual fund. Pangatlo is the return on the fund over the past year, the past 3 years, and the past 5 years in comparison to a broad market index. Pang-apat, the exposure of the mutual fund to various types of risk. Panglima is the services such as check writing, ability to transfer money by telephone or etc. offered by the mutual fund. Pang-anim is the fees incurred by the mutual fund such as management fees that are passed on to the investors. And lastly is yung names of their portfolio managers and the length of time that they have been employed by the fund in that position. Fourth one is the management of mutual funds. Each mutual fund is managed by one or more portfolio managers who must focus on the stated investment objective of that fund. These managers tend to purchase stocks in large blocks. They prefer liquid securities that can easily be sold in the secondary market at any time. Panglima is expenses incurred by mutual fund shareholders. Mutual funds pass on their expenses to their shareholders. The expenses include compensation to the portfolio managers and other employees, research support, record keeping and clerical fees and marketing fees. Expenses can be compared among mutual funds by measuring the expense ratio, which is equal to the annual expenses per share divided by the fund's NAV. Pang-anim is governance of mutual funds. A mutual fund is usually run by an investment company whose owners are different from the shareholders in the mutual funds. In fact, some managers employed by mutual funds invest their money in the investment company rather than in the mutual funds that they manage. Thus, the investment company may have an incentive to charge high fees to the shareholders of the mutual fund. Pang-pito is mutual fund categories. Mutual funds are commonly classified as stock or equity mutual funds, bond mutual funds, or money market funds, depending on the types of securities in which they invest. Pangwalo ay stock mutual fund categories. The more popular stock mutual fund categories include 1. Growth funds. For investors who desire a high return and are willing to accept a moderate degree of risk, growth funds are appropriate. These funds are typically composed of stocks of companies that have not fully matured and are expected to grow at a higher than average rate in the future. The primary objective of a growth fund is to achieve an increase in the value of stocks with less concern about the generation of steady income. Number 2 is capital appreciation funds. Also known as aggressive growth funds, capital appreciation funds are composed of stocks that have potential for very high growth but may also be unproven. These funds are seated to investors who are willing to risk a possible loss in value. And third is growth and income funds. Some investors are looking for potential for capital appreciation along with some stability in income. For these investors, a growth and income fund, which contains a unique combination of growth stocks, high dividend stocks, and fixed income bonds, may be most appropriate. Fourth one is the international and global funds. It were created to enable investors to invest in foreign securities without incurring this excessive cost. Panglima is specialty funds. It focuses on a group of companies sharing a particular characteristic. For example, there are industry-specific funds such as energy, banking, and high-tech funds. Some funds include only stocks of firms that are likely takeover targets. Pang-anim is index funds. It is composed of stocks that in aggregate are expected to move in line with a specific index. They contain many of the same stocks contained in the corresponding index and tend to have very low expenses because they require little portfolio management and execute a relatively small number of transactions. And lastly is yung multi-fund funds. The 9 types of stocks and mutual funds is bond mutual fund categories. Investors in bonds are primarily concerned about interest rate risk, credit or default risk, and tax implications. Thus, most bond funds are classified according to either their maturities, which affect interest rate risk, or the type of bond issuers, or which affects credit risk and tax incurred. Una is the income funds. For investors who are mainly concerned with stability of income rather than capital appreciation, income funds are appropriate. These funds are usually composed of bonds that offer periodic coupon payments and vary in exposure to risk. Income funds composed of only corporate bonds are susceptible to credit risk, while those composed of only treasury bonds are not. Pangalawa is tax-free funds. Investors in high tax brackets have historically purchased municipal bonds as a way to avoid taxes. Because these bonds are susceptible to default, a diversified portfolio is desirable. Pangatlo is high-yield junk bond funds. And pang-apat is international and global bond funds. It contains bonds issued by corporation or government based in other countries. Global funds they differ from international bond funds in that they contain US as well as foreign bonds. And panglima is maturity classifications. The 10 types of funds is asset allocation funds contain a variety of investment such as stocks, bonds, and money market securities. The portfolio managers adjust the compositions of these funds in response to expectations. And ang pang-11 is growth and size of mutual funds. Moving on to learning objective number 3, which is the performance of mutual funds. Investors in mutual funds closely monitor the performance of these funds. They also monitor the performance of other mutual funds in which they may invest in the future. In addition, portfolio managers of a mutual fund closely monitor its performance as their compensation is typically influenced by the performance level. For valuation of stock mutual funds, over a specified period, the change in the valuation of a mutual fund that invests in stocks can be modeled as the formula given in the slide, where MKT represents general stock market conditions, sector represents conditions of the specific sector, if there is one, in which the mutual fund is focused, and MANAB represent the abilities of the mutual fund's management. For valuation of bond mutual funds, over a specified period, the change in the valuation of a mutual fund that invests in bonds can be modeled as given, where RF represents the risk-free rate, RP represents the risk premium, and MANAB represents the ability of the fund's managers. Another is performance from diversifying among funds, ratings on mutual funds, and research on mutual fund performance. Moreover, for learning objective number 4, money market mutual funds, sometimes called money market funds or MMFS, sell shares to individuals and use the proceeds to invest in money market or short-term instruments for their investors. The main difference between money market funds and the mutual funds discussed earlier is that money market funds focus their investment in money market securities. Money market funds send periodic account statements to their shareholders to update them on any changes in their balance. They also send shareholders periodic updates on any changes in the asset portfolio composition, providing a breakdown of the names of securities among held in the MFF portfolio. MFFs can be distinguished from one another and from other mutual funds by composition, maturity, and risk of their assets. As you can see, here is the diagram of asset composition of money market funds. Exhibit 23.10 shows the composition of money market funds asset in aggregate. Commercial paper, CDs, repurchase agreements, and treasury securities are the most common components. This composition reflects the importance of each type of asset for MFFS overall and does not represent the typical composition of any particular money market fund. Each money market fund is usually more concentrated in whatever assets serve its objective. For risk of money market funds, it usually have a low level of credit risk because the money market securities they invest in have low credit risk. Because of money market funds contains instruments with short-term maturities, their market values are not too sensitive to movements in money market interest rates as are mutual funds containing long-term bonds. Therefore, their exposure to interest rate risk is low. For the management of money market funds, the role of money market fund portfolio managers is to maintain an asset portfolio that satisfies the underlying objective of a fund. If the managers expect a stronger economy, they may replace maturing risk-free securities or treasury bills with more commercial paper or CDs. For the last learning objective, other type of funds, in recent years, several other types of funds have become very popular. These include exchange-traded funds, venture capital funds, private equity funds, hedge funds, and real estate investment trusts. For number one, closed-end funds, it issues shares and use the proceeds to make investment in stocks or bonds representing a particular sector or country for their investors. Unlike open-end mutual funds, closed-end funds are closed to new investors after the initial offering of the shares. In addition, they do not repurchase or redeem the shares they sold. It includes the market price of closed-end funds, wherein it can deviate from the aggregate value of the underlying stocks or measured by net asset value per share. Second one is the exchange traded funds or ETFs. They are designed to mimic particular stock indexes and are traded on a stock exchange just like stocks. Unlike an open-end fund, an ETF has a fixed number of shares. They are somewhat similar to those open-end mutual funds that invest in a specific stock index. It includes management of ETFs, capital gains of ETFs, liquidity of ETFs, brokerage fees, short sales of ETFs, and popular ETFs. Third is venture capital VC funds or used money that they receive from wealthy individuals and some institutional investors to invest in companies. They pool the money that is invested in the fund and use the proceeds to create a diversified equity portfolio. These funds typically require a large minimum investments and therefore exclude small investors. Fourth one is the private equity funds, wherein it pool money provided by individual and institutional investors and buy majority or entire stakes in businesses. Such a fund is usually created as a limited liability partnership, and the general partners develop a business plan for investing in businesses and managing the businesses that they acquire. They promote their business plan to attract funds from outside investors who become limited partners of the fund. It includes the market for private equity businesses. Number 5 is the hedge funds. It sells shares to wealthy individuals and financial institutions and use the proceeds to invest in securities. It includes use of financial leverage, hedge fund fees, financial problems experienced by LTCM, performance of hedge funds during the credit crisis, short selling by hedge funds, Madoff fund scandal, hedge funds of funds, and regulatory reform of hedge funds. And lastly is the Real Estate Investment Trust or REIT, which is a closed-end fund that invests in real estate or mortgage. Like other mutual funds, REITs allow small investors to participate with a low minimum investment. The funds are full to invest in mortgage and in commercial real estate. It generates income for shareholders by passing through rents on real estate or interest payments on mortgage, and it includes impact of credit crisis on REITs. So that would be all. Thank you for listening.